Welcome to our Ask an Expert show, where I invite a fellow professional in the US-UK cross-border space to come in and talk to me about the issues we think Brits in America need to be aware of if they are going to thrive here. My guest today is Ishali Patel. Ishali is a senior director with Trowbridge Professional Corporation. Prior to this, Ishali was a founder of Arcos Tax Advisory Services. She was a director at Blick Rothenberg, and she spent well over a decade at Buzzercott. In other words, ladies and gents, Ishali is a well-travelled, highly experienced US-UK tax advisor. And what's more, she is my personal US tax advisor. And I've convinced her to come on the show today to share with us everything we need to know to thrive in America. Well, look, maybe not everything, but whatever we can get into 45 minutes at least. So without further ado, let's get into this. Hi, Ishali. Welcome to We're the Brits in America.
Hi, Richard. Thanks so much for having me. I'm really happy and excited to be here.
Great, super, thank you. So let's get straight into this. So I'm looking at my notes here, and my first note is informational returns. So just some context. We're going to talk about your experience working with Brits in America and the trials and tribulations and the things that you see, and we're going to try and cover off basically what we, or what you especially, wish Brits in America were aware of, or some of the main things. And the first item on my notes here is informational returns.
Yes, so that's a really, really big one because I think it's when you've got people coming over to the US, the reporting is obviously completely different. People are very much aware potentially of, okay, we're going to be paying a different tax rate. There's a different tax system. We've got a federal system, so we might be paying extra tax to our state, whichever state we're living in. But what they're not aware of is how much extra information the IRS want about, particularly about assets that are not particularly in their reach. So, any assets that a US person has abroad is of a lot of interest to the IRS. They don't have any automatic way of understanding what people have outside the US. So they impose these very stringent requirements in terms of information that people have to supply, and attach very high penalties to those filings if they're not done on time, or if they're not done correctly.
Ishali, if I had $1, and if you had $1, I imagine, for every time I heard, but I've not taken any withdrawals. When you mention to someone, so you're not reporting that to the IRS, because, correct me if I'm wrong, but nowhere else do we have to, or nowhere else I'm familiar with, or certainly the developed economies, where you have to supply this trove of information about accounts that you might not take any withdrawals from. There might be no tax due for decades.
Yeah, absolutely, and people don't know about them.
People don't know. Right, number one, people don't know about it. And number two, people have no idea of the potential consequences. And when they do find out the potential consequences, they are understandably horrified.
Yeah, absolutely.
It's so draconian.
It's extremely draconian. They're flat penalties. Normally people are familiar with the idea or the concept that, okay, if I owe some tax and I pay it late, or I don't pay it on time, there might be some penalties and interest that I have to pay based on a percentage of what I owe. But the penalties around these information reports are just flat fees for not filing, for filing late, for filing incorrectly, and they can be really, really hefty. And some would argue disproportionate to actually what the information that they're actually providing and reporting on. I think
I'm one of those people who who claims they're disproportionate and unfair. Draconian is a word I use, and I stand by it. It's just, I don't know. This is one aspect of the American tax system I find really hard to reconcile myself with. And I just wasn't prepared for it when I moved here. I'm plugged into both the US like a tax network on LinkedIn, but also UK for obvious reasons. And I hear people getting all up in arms and upset about £100 UK HMRC automatic penalties, and I just think you guys don't know you're born.
Yeah.
Our equivalent of £100 automatic penalty is $10,000.
Yeah, absolutely. That's the pretty baseline penalty. That's the starting point, and that's typically a non-willful level penalty, not even
Yeah.
So
Here's a question as well, right? So the $10,000 is a number that's always banded around, but are those numbers adjusted for inflation? So they're actually, if someone got a $10,000 penalty today, would it be more like, say, $16,000 because it's $10,000 when that statute came into place? So is that right?
yeah,
So it's
yeah,
actually way higher.
yeah. So for example, I think the foreign bank account penalty is more like 13,000 now.
Really? Oh man. Oh man. Does the tax advisor community like do you get together and like do you speculate on why the US system is like this? Why it's so draconian for on regular taxpayers?
Yeah, I mean, I think it's just very much, the US is just a very inward focusing country. I mean, in terms of tax, and I think the mindset from, I guess, from the government, the IRS is just that, well, if you're going, we want to know what everything about you essentially, and you get, if you think about the way that the IRS get information through 1099s, through K1s, the taxpayer gets a copy, the IRS get a copy. They have this massive supercomputer apparently which churns out matching mismatches and things like that. So
Yeah,
they've got
yeah.
full transparency over a very typical benign domestic kind of setup. But when you throw in a foreign pension, foreign bank accounts, foreign structures, a foreign company, these are areas where the IRS can't just say, oh, right, we want to find out about this, or we know about this, we want to dig into it more. So the way that they try and keep that information, they try and gather that information is through these very draconian penalties and asking for information. I think, one classic example is the reporting around foreign companies. For years, that was, there was a form you had to file with that, which attracted a penalty. But then the IRS decided, well, actually, we want to tax the corporate profits of that entity. And that was almost saying we're going to disregard it. We're going to disregard that it's a company, and we're going to go for the profits within it.
Wow. Yeah, that's pretty more draconian.
Yeah.
Let's just be clear about what we're talking about here. So this is in a common example for us is a Brit moves to America and they've got they've got UK bank accounts. They may or may not have ISAs. That's something we'll come back to, I guess. But they'll almost certainly have UK pensions or UK retirement accounts. And suddenly they are required to report these on multiple forms. It's not just one form; it's multiple forms, right? And each form has its own requirements and penalties.
That's right. And I think one of the reasons, particularly with pensions, that it's a problem is because there are in the IRS. There are two sets of rules that are into play with pensions. So you obviously have the pension rules and the tax treaty between the US and the UK, which is pretty robust, generally speaking, in terms of getting it right for Americans living in the UK and for Brits living in the US, who have retirement savings. But there are also another set of rules in the US around foreign trusts. And unfortunately, sometimes UK pension arrangements, very typical and benign and accepted practices and arrangements in the UK, would fall foul technically of these trust rules in the US. And so you end up with two sets of rules which don't sit very neatly together. And so you end up in a situation where you treat a pension like a foreign trust from a reporting perspective, but then you use the treaty to help with income, etc., generated from that pension. So the penalties for not filing trust information forms are extremely high. And so almost by virtue of the fact that these two sets of rules don't fit neatly together, UK pensions, for example, get caught into that definition. And then as practitioners, because the penalties are so high for not filing those forms, even though a lot of people, especially years ago, people were fighting very hard about, in order to not have to file these for example, UK SIPs or UK pension plans, the risk of not doing so it's not worth it ultimately, because the penalty regime is so draconian. I will use your word because it really is.
Yeah, it really is. Yeah.
Yeah.
I mean, what are we talking about? We're talking 35%. On the initial, so if you do a transfer into a transfer into a trust, right, which you don't report on 3520, which for our purposes could be a rollover, right? A UK pension into a SIP, is the potential penalty 35%?
Yeah, yeah,
35%, and then ongoing 5% of the value,
yeah.
and then distributions as well. If you take it, if you're taking distributions, are the penalties on distributions?
So there shouldn't be penalties on the distributions.
But if you're not filing it on 3520,
Well, you would a distribution would be a. I mean, the distribution would most likely be reported on the return because it would
okay,
either be
oh, of course
it
it would,
would
yeah,
either be taxable or treaty excludable, depending.
yeah.
If you have had a distribution from a foreign trust, there is information on the 3520 form which you need to complete.
So 3520s are a hot topic right now, because of the IRS's willingness and I believe it's like automatic penalties on 3520s. Have you seen people penalised for not filing it for SIPs?
I have actually, yes.
Yeah.
It's been where the IRS have argued that the return was late. So it was actually, typically we had the due date for a 3520 is October the 15th. So typically the IRS, if you send the document and you've got proof of posting on the day of the deadline, the IRS accept it to be timely filed. So we had done that in this particular case, but they're not accepting. They got the document on the 17th, and they're not accepting that it was a timely filed 3520. So they have automatically applied a penalty.
Like,
So it's not really because it was a SIP. It was
understand, yeah.
It was because they think it's
Yeah. It gets me all wound up, this. The thing is, we talk about the Irish do this, the Irish do that, but you forget these are human beings making these calls. Like, someone has looked at this case and thought, yeah, this is deserving of a penalty. Oh, there's these mitigating circumstances, which is not even a mitigating circumstances. It's no, this is on time, and then someone thought, nah, I'm just going to disregard that. I think there's something culturally wrong there, but that's a different podcast topic.
Yeah, no, absolutely. And I think
How to fix the culture at the IRS.
yeah, I mean, I think it has been unfunded for a long time, and a lot of the representatives, generally are very domestic focused, so they don't tend to be very aware of foreign issues. I think there is an international team now, where people are more aware of issues that are facing anyone who's got foreign assets, really. But it's taking time.
And you know what? Something that I've come to realise is that the people really are tax evasion. There is a real tax evasion problem. That whole I don't know, it was years ago, but the whole Swiss banks thing. People that was naked tax evasion. People were hiding accounts and not reporting income. So maybe it's the long tail of that. Like, they uncovered real, actual systemic tax evasion. And I've also just finished reading a book on Bernie Madoff's Ponzi scheme, which was really fascinating. 15 years on. But there's a lot of the talk is about there were a lot of mega wealthy investors, like literal billionaires and they knew better, and they absolutely knew what was going on. That's the thesis of this book, and I buy into it. But what also came out is how absolutely committed to tax evasion these billionaires seem to be. Like,
Yeah.
and when you think that the richest people in this society have got a reputation that, in some respects, seems legitimate for not paying their fair share of taxes and going out of their way actually to not pay it. Does that cascade down? Is that trickle down economics, American style, where the rest of us who are trying to pay our fair share and not trying to hide anything are kind of tarnished with the same brush?
Yeah, absolutely. And I mean, I think people who don't sit in the cookie cutter kind of traditional profile of a US citizen living and working in the US, they get, the IRS are just very, very nervous. I think the whole UBS thing, as you said, that was the conduit of FATCA and and now, there are a lot of, I think the Swiss banking, well, the European banking system really got a shock as a result of that. But the amount of money that they anticipated, that the tax gap, I think this was 10 years ago now, that the tax gap that they were banding about was billions, and if you think about that, how would you go about collecting that revenue? Okay, you either invest a huge amount of money in IRS inspectors and auditors and all that, or you push the obligation onto the taxpayer, right, and use penalties and scary forms and things to force compliance. And I think that's probably the way that they decided to go. What's kind of counter to that really is the Streamline program, which has been around since 2014. That's a disclosure program which allows you to someone who hasn't been filing to catch up, and that still gives you protection from the 3520 penalties or the foreign bank account report penalties. So the IRS has still kept some kind of avenue open for people to get back in the system in quite a benign way. But I think after the whole Swiss bank situation, I think the whole premise of FATCA is let's push the responsibility to the institutions and therefore to the individuals. And also there are, in fact, preparer penalties. So we're also on the hook for filing fraudulent or frivolous tax returns.
So FATCA, this is a piece of legislation that stands for what? Foreign Account Tax and Compliance Act.
Yeah.
2012, 2011?
Yeah.
Obama era.
Yeah.
Following this whole Swiss. And it's this act that's really that's led to so many of these additional requirements and forms that we've been referring to. 8938, 3520s, 8621s, all the stuff that we've either specifically mentioned already or we've alluded to. There's other stuff as well, though, outside of these forms. So the Bank Secrecy Act is FBAR and PFIC regime from it predates all this, I understand. But you practiced as a tax advisor pre-FATCA?
Oh, yes.
Right?
Yeah, 10 years pre-FATCA.
What was it like? What was it an easier time? What was it like?
The foreign bank account reports were not taken as seriously as they are. I mean, they have been around for a long time, but
the FBAR ones.
Yes. Yeah.
Yeah. So just so people know, that's under the Bank Secrecy Act, right? That's from the 70s, I think.
Yeah. Yeah.
And just so anyone who's unfamiliar, that's where you have to report any and all foreign bank accounts, but investment accounts, pensions, we believe, just any foreign account, not just a bank account, which is so often misunderstood. And another area that's misunderstood, this is when the combined aggregate totals of all accounts together crosses the $10,000 threshold.
Yeah, that's correct.
Absolutely. If you've got one account, you keep it below $10,000, you don't need to worry about this. But if you have multiple accounts, if you have pensions, if you have investment accounts, if you have just multiple bank accounts, if at any point the combined total is more than $10,000, you have to file an FBAR.
Yeah, that's absolutely right. And I remember when the foreign bank account report legislation, as you said, was always there. They did start to expand it, and they introduced a really big FBAR toolkit not recently, but a few years ago, and there were discussions around whether an Oyster card, for example, in the UK would be a foreign account.
Yes. Yeah.
Premium bonds are a foreign bank account. Life insurance, if life insurance, if there's a cash surrender value, most types of pensions. So I think that the scope of what is included in an FBAR has expanded more and more over the years.
Yeah. Wow.
And I think one really interesting case, I'm sure, I don't know whether you followed it, Richard, it went all the way up to the Supreme Court about whether the FBAR penalty should be applied to every bank account in every year that the file wasn't formed, or whether it should just be one per year. I don't know if you recall that, but the taxpayer won in that situation.
Thank goodness.
Thank goodness. Otherwise, I think so. In just a little bit of background, there was a taxpayer who hadn't filed these forms. He filed them late. he had about 50 accounts, I think. I can't remember how many
Yeah.
accounts he had. And they wanted to impose a $10,000 penalty on each account for each year that he was delinquent. And it went all the way up to the Supreme Court.
I mean, it was like the difference between something like a $2.6 million fine plus interest and penalties versus a $50,000.
Yeah.
So they wanted to charge $10,000 for every account for 5 years, and that's where they got to 2.6 million. This was a phenomenally successful guy who'd gone back to Romania, I believe. 2.6 million to $50,000.
Yeah.
It was remarkable. And do you know what was funny as well about that was the split of the Supreme Court. I found myself allied with people I wouldn't necessarily normally be allied with.
I agree. I was
But
surprised as well.
yeah.
I was really surprised at how
It was close call, wasn't it?
It
It was a
was.
3, yeah.
I think
5-4.
I saw people aligning. I don't think I'll ever see aligning again. Let's put it that
Yes,
way,
same.
without getting into politics.
I'm reaching back into my memory here. I could be wrong, but I think it was the new one as well, Ketanji Jackson, who was a deciding factor.
Yeah,
So
she was, and
you know,
she was.
I think she was on the right side of that, despite siding with people who I'm sure she won't side with that often going forwards. But I think she got that one right.
I agree. I agree. Because I think her argument, it's probably really getting into nuance now, but her argument, I think, was that the act of having an account overseas is not in itself a criminal, like it is not an unreasonable or criminal act. So
Yeah.
therefore, that was some part of her argument, I think.
Yeah, absolutely. So what was it like pre-FATCA doing your job?
Pre-FATCA, I just think it was. I mean, people took it seriously. You know, the forms like, you know, the 30, they were all around, but no one was doing them for SIPs, for example.
Uh-huh.
No, you know, no one would even consider doing a 3520 for a pension plan, for example. I don't, you know, the corporate reports were just relatively basic forms, no tax associated. You would only see a 3520 if someone had a gift from a non-U.S. person in excess of $100,000, and actually that is something that can affect Brits living over in the US, because I've had
Absolutely.
quite a few clients who transferred property back home, or you know, they've received inheritances from family, you know, and that also needs to be reported on the 3520 as well. And that's something that a lot of clients have just got no idea that they need to do anything with that.
So that existed pre-FATCA.
Yeah. So that's where we would see it in most
And
cases.
just so everyone, so this is when as an American, as a US person, if you receive a gift or an inheritance of more than $100,000, you have to report it on this form 3520. It's just one line, right? Just reporting one line.
Yeah.
Doesn't mean there's tax to pay. Currently, if you don't do that, you file it late or you don't file it at all, you can get penalised 25% of the value of the gift.
Yeah.
And my understanding of it is they are aggressively levying these penalties.
Yes.
Pre-FATCA, were they as aggressively levied?
No, we would never even see. I mean,
Really?
to be fair, I've never seen an FBAR penalty applied to date still, but at 3520, absolutely, you wouldn't. I've never seen a flat prior to FATCA. I'd never see a flat 3520 levied.
Wow.
Never. Same with FBAR. I mean, you used to have to paper file them as well, so you just bunch them in together and send them off. And they went. I think they went into this big warehouse in the IRS that no one ever looked at again. I mean, now it goes straight into the financial. It's the crime, the FinCEN, which are Financial Crime Enforcement Network or something like that.
Yeah. And what do they do with them, I wonder?
I don't think that. I'd be surprised if they do anything with them.
Yeah.
But yeah, so the other thing that I would see a lot, the states were not as aggressive on working days. So that's another thing, you know, if you're sitting in, you know, Massachusetts or Connecticut and you're working in New York, you've suddenly got a New York filing requirement. if you had someone who was a Brit working in the UK and just came over to the US for a few working days, I don't think people would be worried about filing in New York or California, whereas now very much you would be even for one or
Wait,
2 days.
what you do a few days work in a different state, and you're meant to be filing a return there.
Yeah.
What are we talking, like no threshold, like just one day?
So there is no threshold. So I would say pre the financial crisis, when the states were not as cash hungry, I suppose,
Uh huh.
we would have maybe internal limits to say, okay, if it's less than five, there's no need, and below certain exemptions, we wouldn't file a New York state return or a California state return or something like that. But, the situation is such now that we've had clients who have been tracked in and out of New York. So
How? On like
the
bus tickets and train
passport and
tickets?
like, yeah, so it's
Wait, sorry, Shai, this is so you have clients who are tracked. You said passports, so they've flown in from the UK and they've done a couple of days working in New York, and then New York expects them to file a return and pay New York state income
that is
tax.
what the rules say, yeah.
No way.
Yeah.
And they've got taken it to such an extent that they've tracked down their passport movement, basically.
Yeah, so I mean, it's gotten easier now. Everything's electronic, But I've had, the particular client that I'm thinking about, he also did have a rental property in New York, so
Ah,
they had
okay.
another connection.
Okay.
So
Right.
but that made it easier to trace them. But
Wow.
yeah, and I've had a
And so, Charlotte,
resident quest. I've had a Brit move from New York to Austin, and he's only been in New York for a few years, so he's not domiciled or he's not from the state, and they are question. We've got an audit on his
really?
return. Yeah,
Wow. So, Ishali, I mean, I never go, I'm just for the record here, whoever's listening, I'm Connecticut based. I never go into New York, but in this hypothetical situation, right? If my situation changed and I worked 1 or 2 days a week in New York, say, oh, no, forget that. Sorry. Over the course of a year, I worked 5 days, just 5 days in New York. I went in because I wanted to hang out in New York. I would have to file a New York tax return and pay a tiny fraction of my income to income tax in New York, and I'd get wow, I'd get a credit in Connecticut, right?
you would only get a credit in Connecticut if there is a reciprocal agreement between Connecticut and New York, and most of the surrounding states, like most of the East Coast states, have reciprocal arrangements with New York. But if you were based in New York and you went to California, or you're based in Connecticut and you went to California, California would expect you to pay tax on days there, but you may not get a credit if there isn't a reciprocal
No
agreement between
way. So
Connecticut
you'd
and
get state taxed twice on some income without any offset. Did you use those examples intentionally? Do you know for a fact? Yeah, do you know that there's no agreement between those states?
I don't think there is, but I because California typically would sign with the surrounding, and New York have signed with the surrounding.
Because that must happen all the time. People from New York must go to California every single day to work.
Yeah,
That's nuts.
yeah.
What about people coming from the UK to work for a week or two or a month or two in New York? Is there I guess there's no reciprocal, obviously there's the federal tax treaty, but one presumes there's no agreement between any state and the UK.
That's correct. Yeah,
So would they get taxed twice on that income, once in the UK and once by New York without
yeah.
any relief?
They would. They would. But well, they would get relief for New York state tax on their UK return.
Oh, they would they?
They
Okay,
would.
good,
They
good.
would, but they wouldn't get, yeah, relief, and they would be able to. I suppose if it's they would get up to 10,000 of that as an itemized deduction on their federal return if that's
Uh-huh.
helpful for them. But you would have to suffer that.
Charlie, this must be the thing that is the most, non-compliant issue in the US, because
I think so.
Americans travel all the time for work, and I can't imagine many are filing tax returns in every state they go to for 1 or 2 days.
Yeah, agreed. And it is a minefield.
Wow. Wow. So we talked about informational returns. This is such a big one. There's a myriad of different forms for different accounts. Often you think I filed an FBAR, yeah, but you didn't file a 3520 or an 89, yeah, and you know it's a nightmare, and the penalties are horrifying, even for what I call innocent non-compliance. But one of the other things I wanted to talk about was PFIC regime, because this is another thing I think that catches out. Not just Brits. Obviously, I'm talking about Brits because that's who we work with. But anyone who comes to the US from outside the US, the PFIC regime. Now, I understand. Well, let me explain. So, for me, the PFIC regime is how non-US investments are taxed in the US. Not just taxed, how they have to be reported.
Yeah.
And for obvious reasons, so many expats move to the US mid-career, and they have non-US investments. They spent 10, 20 years, whatever, working and saving, and they have these oftentimes totally benign, mainstream, European or Australian, or whatever, mutual funds, ETFs, and now they're subject to the PFIC regime. So talk to us about the PFIC regime.
Yeah, so the PFIC regime essentially is a tax regime that essentially punishes, I would say, people who decide to invest in non-US products rather than US domestic offerings. Now, the rules don't apply if you're investing in straight equities. So if you've got shares in BT or in, BP or AXA or something like that, then the PFIC rules don't apply to you. But if you've invested in UK unit trusts, for example, growth funds, that kind of thing, then the IRS sort of say that, look, these funds potentially could be rolling up income without distributing them, and therefore it's a tax shelter. So that's the perspective of the IRS.
Right, to be fair, Ishali, they do, right? There are accumulation units for UK mutual funds. They are rolling up the income. They're not a tax shelter.
Exactly.
It's
yeah.
just, it's a way of reinvesting dividends.
Yeah.
But
exactly.
the IRS looks at it and says, no, I don't care what the purpose is. It's a tax shelter.
Yeah. Exactly. So the way that they apply the PFIC regime is that they tax you at in two different ways. So the first way that they tax you is on distribution from that particular fund. So that would be typically in the US, you would get if you got a dividend from a individual stock, you would get a lower qualifying dividend rate at 20%, 15 or 20% on that dividend. For a distribution from a fund that is deemed to be a PFIC, that would be taxed at the highest rate in existence. So regardless of even your effective rate, if the top rate of tax is 37%, you'll be taxed on that distribution on 37. In addition to that, what the IRS would do is they would look at the previous 3 years of distributions. And if that distribution, if the current year distribution exceeds 125% of the average of the last three, they would levy an interest charge on that distribution on top.
What is this called? The excess distribution regime, right?
Yes.
Yeah. So you're going to get hit with the highest income tax rate available, 37% currently, previously 39.6, whatever, plus interest.
Yeah. The cost basis is as the original purchase date, but the ownership period across the interest charge is only applied from the date you become a US person. Yeah.
Oh, that's so interesting. Let me tell you a real life story, and I don't know how this played out because this guy didn't like what he heard, and went quiet. I was approached by someone. This is a few years ago, and he was an accountant. And he told me he was an accountant straight up, and he'd been managing his own investments for a number of years. I don't know why that he'd done his own taxes and managed his own investments for many years, and his was because he was an accountant. That's what he told me. Anyway, we have a conversation. It turns out he moved here in the 80s, and when he moved here, he had a portfolio of PFICs, mutual funds from the 80s. And we had this conversation. I think it was the depth of COVID, so this is 2020.
Okay.
He'd had these PFICs from the 80s when he'd moved here. and this portfolio of PFICs was now worth, I think it was about it was either £1 million or $1 million, and a lot of that, as you can imagine, over 30 years, nearly 40 years, was gains, and he'd moved in the 80s, so and he had this portfolio of PFICs, and he thought he was going to have to pay tax. He'd not reported them on any forms.
Oh my God.
And he thought when he sold them, the tax was going to be, just regular federal, and if it was, I can't remember where it was, federal capital gain, long-term capital gains tax. And once he became aware of the PFIC regime, first of all, you've got the problem of non-compliance reporting. Second of all, you're looking at 37%, 39.6% for some years, plus interest going back 30 odd years.
Oh my God.
We're talking like all that gain practically.
Probably
I reckon I can't remember what it was, but I did back of a fag packet. I can say that because you're British. I did back of a fag packet calculation, and I was like, it was like we're 80% plus of your gains going in taxes plus interest here, and I'll never forget it. And that was he'd been happily doing his own taxes for 30 years.
Oh my God.
And one conversation with someone, a cross-border, not even a tax advisor, a cross-border finance advisor, could have diagnosed that problem and got him out years and years and years ago. And there is no way out. As far as I can tell, there was no legitimate way out other than coming clean and just taking the hit. I don't know what he did, but it's always stuck with me.
All of that money nearly all of it's gone to the tax and interest.
It's horrible.
Yeah, 75%.
It's horrible. I honestly, Ishali, I think a date roughly when I started becoming a zealot about this. I am a zealot, right? I a self-admitted zealot about the need for successful Brits, any expats in America, to work with a cross-border tax advisor. Not any tax advisor, not a local. Heaven forbid, don't do it yourself, please. I shiver. I literally shudder every time I hear the word TurboTax. You might have to edit that out. I'm not sure I can say it. When someone says a DIY, a tax return, I shudder. But I also mean going and seeing someone local and getting 1040 for 1040 is a recipe for disaster. And I am a zealot about promoting the requirement for successful Brits with cross-border affairs to work with cross-border professionals, and I might date it to that conversation, that realization that a conversation employing a cross-border professional years ago could have saved this guy hundreds of thousands of dollars in tax and penalties and in interest and God knows what in anguish.
Yeah, absolutely. And I mean, if you take advice early on enough, then there are certain elections you can make to mitigate the tax regime for PFICs. There are a couple of elections that you can look at, which would mean that you would avoid those interest charges and this higher rate. So it is really important to get advice as early as possible, really. I mean, sometimes we would say to Brits, one of my first questions is when people are going over is kind of, how long do you think you're going to be there? And obviously that is a difficult question to ask, but to answer sometimes, especially at the beginning. But if a client's saying 3 to 5 years, I might say, okay, just move if you've got funds in an ISA or something, move them into growth funds, don't dispose of them, and then when you come back, sort them out again, but so there are things that you can do if you do take advice early to kind of think about how to manage those. If disposing of them is not an option, some clients, if they're going on fully for retirement or that kind of thing, then yes, get rid of them all and move on is a good place to start.
This is a perfect segue. Let's talk about pricing, right? So I mentioned I'm a zealot for people working with cross-border professionals, in this case cross-border tax advice. Now, one of the pushbacks I get all the time is people are scared about the price. People are fearful, it's going to cost them a fortune. And it's two parts to this. One is me trying to get them to see, because me just saying it doesn't really. It's trying to get people to understand that yes, you might be paying $500 for your 1040 right now, but it's a false economy. It's a false economy. If the moment I look under the hood, I spot all these problems where the potential I'm not saying you get whacked with all the penalties, but the potential for penalties is staggering, or taxes in this case. So one, what you're doing right now is a false economy, and two, there's a premium. Of course, right, we're talking. You go and see someone local. They only have to deal with one system, the American system. You go and see someone. You want to see a cross-border professional. You need someone who understands the US, who understands the UK, where you're presumably for our cases, where for these purposes, where your non-US assets are based. It's no good just having. I don't think it's any good just having someone who's generically cross-border, because each country has its own financial instruments, and it's very fact specific on how it's treated in the US. So we need someone who understands the US, who understands the UK and their product landscape, and then critically, who understands the interaction between the two, i.e. the treaty. Of course there's a premium for that. That is highly specialist knowledge. The fact that you can barely find anyone who does it is evidence of how specialised it is. And it's a premium worth paying. I pay it. Right? That's why I wanted you on so much, because you're my tax advisor. I pay, and it's a very fair premium. I don't want to scare people that we're talking ridiculous money here, but I pay a premium for my tax advice and my tax preparation, a very fair premium, because I understand, one, the complexities involved in it, and two, the repercussions of getting this thing wrong.
It is very, very complex, unfortunately, anything cross-border, and I think a lot of clients think that they can do it themselves, or they can use a simple software package and get it right. But we typically use the more the more advanced sort of packages which deal with most of these forms and all the reporting. We still have to manually fix them, so they're not the best package in that we work with some of the most sophisticated packages. Even nothing beats really as well being able to actually just talk to someone who's I'm British. I've lived here in the UK for most of my life, and most of my clients are cross-border UK Brits here, Brits over there, US people over in London or England, and I think just being able to deal with simple things. Okay, how does the foreign exchange rate affect my taxes? Yes. How does that tie into investment advice? How does that, all those sorts of things you only really know through knowing both sides of the house. That's really where my viewpoint is on it. And I think a lot of clients get into a lot of problems that we end up trying to help them fix.
Yeah, 100%. One of my favourite sayings is it's better to prepare than it is to repair, and it's a lot less expensive to prepare. It means ponying up front, but I promise you it's a lot less to pony up front than it is to repair down the line, especially if at that point the IRS are already involved. Then it gets really expensive. Yeah. As we wrap up here, Ishali, I also want to bring up one thing now, which was new for me when you guys offered it, which was this pricing structure that you've introduced at Trowbridge, whereby, historically in the past I paid a fee for my tax preparation to people, and then recently you guys offered me a different setup where I could pick between three prices: one for just pure preparation only, and anything that followed from that would be on the clock. If I categorize this wrong, please correct me. No. Anything that followed from that would be on the clock. And a second tier where it was like the cost of the preparation, and then anything that results from that, any queries from the IRS, even up to full blown audit, if I understand correctly, would be included in that price. And then a third tier, a more expensive tier, which was all that plus any and all tax advice within reason. I guess there must be some sort of limit, but practically any and all tax advice.
Yeah. I mean, that we really like that package, and generally clients really like it as well, because they can choose what the right package for them every year. So we don't, they might, so if a client's got a lot going on one year, they're buying a house, they're moving state, they're moving country, they're having children, getting married, whatever it is, and they think, okay, we're going to need quite a lot of support this year, they can choose the all-inclusive. But then the next year when things go back to sort of normal, and they've got a very sort of stable, and they could then choose the basic for that year. So I think the clients really like that ability to know what they're getting up front, and we don't bill on we don't bill on an hourly basis, so we really think a lot about, we do fixed fees for these packages, and we really think a lot about how to price them fairly for the client, as well as being representative of the value that we're adding. But yeah, thank you. I'm glad, it's nice to get good feedback on it. And yeah, we have been using that those packages for a while, and I think it actually yeah, has worked well. Given I've also come from a background where it's been, we've done on the clock billing, and I've seen how that can go sometimes.
Clients don't like it.
Yeah, yeah,
Which I understand, but I really liked it. So I picked the middle tier because for now, my affairs are relatively static. It's interesting to know what you said about people who select the third tier. So if I was like moving back to the UK, for example, that would be the year to do that. That's really interesting. But I'm going the middle tier because like most people, I worry one day I'll be audited. I hope I never am.
yeah,
But just worry that one day that will happen. And when that happens, I imagine that your costs balloon. You got accountancy costs, you might have lawyer costs, you might have time, all stuff. And I picked that one knowing that hopefully I'm never audited. But if I am, and it might not be for 20 years, I'll happily pay a small premium every single year for 20 years, or even never, knowing that if and when... if I'm ever audited, my accountant's there, has got my back, and I don't have to worry about those costs ballooning. And I see it as a form of insurance, honestly, and I really appreciate that. So I like it.
excellent. I'm really glad you like it. I'm really glad. Yeah, we've had good feedback on it, and I think I like working that way as well, because the clients are just, there's a lot of difficult discussions I've had over my career, when the client's had a bill that's double or triple what they've been expecting.
Yeah, exactly.
And
yeah.
it's, they're like, hang on, first of all, I'm dealing with something really difficult, and then now you're doubling your fee, or you're tripling it. And
Yeah. And I get both. You have to, if you're dealing with something difficult and you've got the professionals involved, yeah, you have to charge for that. But it does also feel like come on, guy, I'm getting it from all sides
Yeah,
here. I don't need
yeah.
you throwing bills at me. But like, what can you do? Whereas this says, no, you made that decision up front. You either went for it, or you didn't. And if you didn't, now you kind of have to pay. So I'm a big fan. Right, Ishali, thank you so much for coming on with the Brits in America. If anyone wants to find you, where can they track you down?
Yep, so if you go to, I'm on our Trowbridge website at www.trowbridge.ca, and my LinkedIn as well, and yeah.
And of course, come to us. We can make sure you find Ishali as well.
Yeah.
So don't be shy to reach out to Plan First Wealth. Excellent. All right, thank you so much for coming on, Ishali.
Thank you.
Cheers.